The idea of a strong dollar sounds just great to most people. However, when they look at their 401ks, they realize a strong dollar might not be all that good. So what is going on here? Why is the dollar getting stronger right now? Why does it look like it's going to be moving even higher from here to levels it hasn't been at for years? And why is that bad for asset prices? Ready? Let's dive in. First things first, a word from today's sponsor, iTrustCapital. Now, most people today are aware of how well gold has performed relative to pretty much every single asset class out there. We've seen an absolute crash take place in tech stocks, in the broad stock market, in cryptocurrencies. We are seeing blood in the streets everywhere, but gold has been keeping up. Gold has been increasing its purchasing power relative to these other assets, and many people want to buy it, but the problem is most people have most of their wealth tied up in their 401k, in their retirement account, maybe even with their current employer. So the question is, how do we invest in gold with our money if we can't do it where our money's currently at? And that's where iTrustCapital comes in. Because unlike your workplace employer plan, like your 401k, you're not just going to have a selection of a couple dozen mutual funds that are only invested in stocks and bonds. And unlike your IRA with a regular stockbroker, with iTrustCapital, you're not just going to have access to the regular stocks, the ETFs, GLD, SLV, things like that. With iTrustCapital, you can invest in physical gold, physical silver, that's all held underneath the banner of the IRA so that you don't have to worry about any tax consequences. You can do traditional IRAs, you can do Roth IRAs, you can make new contributions, or you can even transfer money from your existing retirement account over to iTrustCapital and use that to invest in physical gold, physical silver. Now, they also have other alternative assets available like Bitcoin and cryptocurrencies. And if you use my link in the description below, you will get $100 worth of Bitcoin as a sign-up bonus just for opening an account. You can use that to keep it in Bitcoin, buy other cryptocurrencies, or sell it and buy physical gold, physical silver again in your IRA. With iTrustCapital, sign up with my link in the description today. All right, so there are a number of factors going into the dollar's rise, and part of that has to do with large recession risks, because markets are starting to fear that the central banks will have to fight inflation to the point that will cause a recession. So let's take a look at some charts to see what is going on. First, let's take a look at the dollar. This is the dollar index. It is the dollar measured against a basket of other currencies. You can see down here, this is 2022. You can see the dates. We have just been going up higher and higher and higher since last year, and we are almost at an all-time high for this year, which when we pull back to a monthly chart with these monthly candlesticks, we can see that we haven't been this high since 2002. Zooming out even farther to the 70s, we can see that we are almost never above this level at 109. We were briefly during the 80s for a couple of years during that big spike and then drop, and then we were briefly again in 2000 through 2002. But apart from those spikes, we are always below this level and generally below 100. The reason for this being the case is because the dollar is still the global reserve currency, meaning that it makes it very, very difficult for the rest of the world when the dollar is expensive, because the dollar is used for most international trade. So if you can't get your hands on the same number of dollars that you used to be able to with your local currency, that makes it more expensive to get the stuff from other countries that you have to import. And most of the world imports most of the stuff that they need. And so this makes it very difficult, especially for emerging markets, to get this stuff they need. As the dollar gets more expensive, so does everything else. Adding to this problem is that it's a little bit of a self-reinforcing cycle. As dollars become relatively more scarce, it means that countries have to print more of their own currency and sell more of their own currency in order to obtain dollars, which puts downward pressure on those currencies and upward pressure on the dollar. Now, what could be done in response to this to help it out is to make the dollar artificially weaker versus other currencies by simply printing more of it. But the Federal Reserve right now is dealing with their own set of inflation that they're trying to get down. Now, the way you could ease these pressures is for the central bank to artificially lower the value of their currency by just printing more. So the Federal Reserve could print more dollars to push down the dollar relative to other currencies. However, they can't exactly do that right now, given the fact that they're trying to fight their own inflation, which is causing the futures markets to now price in a higher chance of a 75 basis point hike by the Fed instead of the 50 basis point hike in order to fight inflation a little bit harder than was previously expected. Now, because the market is pricing in much higher likelihoods of the Federal Reserve trying to fight inflation harder and longer than we originally anticipated, the market is pricing in this recession now, and one of the ways it does that is with the yield curve inversion. This is the chart of the interest rate on the 2-year United States government treasury, and you can see that while it does trend down from its peaks, we are now above that trend line here, and the 2-year is sitting at about 3.3%, which you'll notice as we move over to the 10-year here, that is above the 10-year that is currently sitting at 3%. This is factoring in a couple of things. Number one, it's factoring in potential success from the Federal Reserve in fighting inflation, because those inflation numbers will come back down in between the 2-year and the 10-year mark, meaning that there's a little bit of logic there in accepting the lower interest rate on the further out maturity there. The other thing it's factoring in is a higher likelihood of recession, that the Federal Reserve is so successful at fighting inflation, they plunge the economy into a recession. We maybe even get deflation in between now and then the Federal Reserve has to come in and save the economy by lowering interest rates, and all of that, there are more chances of those things happening the more time you give it, so that 10-year would be lower than the 2-year to price in the higher likelihood of that happening in 10 years versus 2 years. This is putting negative pressure on asset prices such as gold. We see here that we've been trending down since it peaked from the Russian invasion back in March, and has been down in this channel since then, this bull flag, and we did not have a successful breakout in early August this year, and we came back down into this channel, which we would then expect based on these bearish forces from the rising dollar, the recession fears, the rising interest rates, that this price of gold would come back down to at least 1680 here to retest this long-term support that we touched in July and in August of 21 and in March and February of 2021, and then all throughout here it was support and resistance during 2020. If we do break through that support line there, I would anticipate a quick drop down to probably the 1550 level and then a quick rebound as well. And so during this time, it's a great time to be buying the volatility, dollar cost averaging your costs lower with something like gold as it moves down here, because we know eventually the policy response of central bankers is to ease. Gold anticipates the results of monetary policy. Right now, monetary policy is tighter. As soon as they flip, then gold will start to anticipate the results of that easier monetary policy. That would be the time to start going all in, but right now, great time to nibble. Silver, as it usually does, is showing similar performance to gold, just to a greater extent, like a leveraged version of gold. And so we are seeing a little bit more of a drop in silver compared to gold as we're down here at this $19 mark. Bitcoin has been in a bear market since it topped out at 68,000 here. We've had a few bear flags, like here during March, here during May and June, and then we've been in a bear flag ever since we bottomed in June at 17.5. We've been coming up here, and just within the last few days, we've broken out of that bear flag channel here, and depending on where you draw the line, we should expect another confirmation drop from there, not to come back up within that channel, and it could be very easy to see Bitcoin come down here and hit this $14,000, $13,000, $12,000 $2 level where there's a lot more support. Filling this gap will not take that much energy as there is just not a lot of volume in between this $19,000 number and this $12,000 number. But it's not just gold, silver, Bitcoin, alternative money forms that are experiencing some pain as a result of the dollar strengthening. We're also seeing regular assets like the S&P 500 has been taking a beating over the last few days as the dollar has been moving up higher and bracing to explode out higher. And remember, since this is prior resistance here, we might have a retracement and then come back up and retest. Might take a little bit more energy than not. However, once we do break above that, we should experience a severe move higher as we will not have more resistance above that. The NASDAQ has also taken a beating the last couple of days, down over 2.5% on Monday. S&P 500 down over 2% on Monday. The Dow down a little under 2%, Russell 2000 a little over 2%. And the key problem here with all this that the markets are starting to price in is the question of how long will this inflation persist? Because it's not exactly like it's all due to monetary policy now at this point. We're seeing effects on inflation that are the direct results of things other than monetary policy. Now, I could make an argument, and I have in the past, that the things that we're seeing, the deglobalization, the war, the fact, the geopolitical tensions, a lot of the factors that we're seeing play out right now contributing to prices going up, at the source of those is monetary policy. Sometimes you have to go back years, maybe decades to see that, but abusing your money and abusing monetary policy and spending decades and decades and decades overprinting and causing easy credit conditions, manipulating your currency versus the rest of the world, abusing the position of having the global reserve currency is going to lead to a buildup of energy that will eventually break. When you have an ice cube and you increase the temperature, for those of us in America using smart units, from 10 degrees to 15 degrees to 20 degrees, 25 to 30 degrees, it's still an ice cube, it's still frozen. You go up one more degree, still frozen, and as soon as you get to 33 degrees, bam, it's liquid. It wasn't just because of that last degree change, it was the cumulative effect of all of the energy buildup before that allowed you to get to that last one. And so the fact that we're experiencing a lot of things right now contributing to prices going up that are not directly monetary policy doesn't mean that you can't trace those back ultimately to the abuse by central bankers and central governments for decades. And with things like trade tensions, high energy prices, a tight labor market, dependence on hostile nations for your energy supplies, not to mention food instability around the world, all these factors are contributing to higher and higher prices as globalization starts to unwind. This is going to make central banks' jobs for fighting inflation very, very difficult because you can't just raise interest rates and expect that oil is going to stop going up. Which means that despite central banks trying to fight inflation, we could expect that the dollar may continue to move higher, that interest rates might continue to explode to the upside, and inflation, at least in the utmost necessities like your food, your energy, your housing, your transportation, the stuff that people just won't give up, they'll give up everything else in order to make sure they can afford those things, those prices could continue to accelerate even if the headline inflation number moves down. So brace for impact as we move into these uncertain times where the prices of the stuff that people need could continue to move higher as asset prices continue to move lower. Eventually wages stop adjusting upwards as well. We could be in for a time of some pain, which means that now it is more important than ever to, as much as possible, increase your income. Do whatever you can to start making as much money as possible. Start nibbling on these assets as they become more and more and more discounted, more and more on sale. You're going to start to see stocks that are at relatively reasonable valuations if they're not already there. You're going to start seeing companies that are valued very well, that are below book value, that are discounted, that are on sale. Asset prices are going to start to get to a point here soon, if this continues, that you will be happy to buy them at these prices, again, as long as you can hold them, because you never know how long it will take. All you can know is whether you bought a good asset or not. So that would be the number one priority during times like this, is to increase income, because times are getting tough. And so the more you can get ahead of that wave so that it can push you instead of being dragged behind it, the better off you'll be. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.